It's Friday the 10th of April, and this is your Capital Economics Weekly Briefing. Coming up, what's happening to oil shipments through the Strait of Hormuz, and how far can financial markets recover if this ceasefire holds. But first, to talk about what's next for the global economy, I'm joined by Group Chief Economist Neil Shearing. I'm not going to say hi, Neil, because apparently that annoys some listeners. I'm going to say happy Friday, Neil.
Happy Friday, David.
Ugh, let's move on.
Unless you're listening on Saturday, in which case, happy weekend.
Okay. Let's move on, shall we? Peace in our time. If by our time we mean the next 10 days or so, maybe, who knows? We do have what looks like a very shaky ceasefire between the US and Iran. Israel's unclear. But in terms of the macro outlook, what does this all mean? What's the message for clients?
Well, as you say, it's a pretty shaky ceasefire, isn't it? If you look through the 10-point plan that Iran has apparently put to the US, I mean, some of those include clear red lines for the US and, for that matter, for Israel. US pulling out of bases in the region is one obvious one. Also, Iran maintaining control over its uranium stockpiles, that's likely to be another. The lifting of sanctions. So there's lots here, I think, in the plan that could be significant roadblocks. Both sides are going to have to compromise if we're going to find some kind of lasting resolution to this conflict. I think they're the headlines. I think that's broadly accepted. However, I would say that the positive this week is that both sides are talking, or at least appear to want to talk. So it seems like there might be a sense in which both sides are looking for an off-ramp, and that can only be positive. If this holds, and if indeed we do get an off-ramp, then I think what this does is it broadly puts us in line with our baseline macro scenario, which is to say conflict eases over the course of this month. By the end of this month, shipments are starting to resume through the Strait of Hormuz. Energy markets are starting to normalize. And in that scenario, we get a weak spot for the global economy in Q2 and in Q3. We get a slowdown in consumption growth, particularly in advanced economies, but we avoid recession. We get a bit of stagnation in Europe, but we avoid recession. Of course, there's an altogether more adverse scenario, which we've talked about before in our research and on this podcast, where the conflict continues, the ceasefire potentially falls apart, we get renewed dislocation in energy markets, renewed surges in energy prices, and in those scenarios, we start to see recessions emerging in key parts of the world.
So just to be clear, if this ceasefire doesn't hold, as you say, it does sound like both sides are looking for an off-ramp here. But if the ceasefire doesn't hold, does that make this adverse scenario that you've just described, does that make that more likely, or what happens then?
Well, it all depends, I think, on the circumstances in which the ceasefire doesn't hold, and in particular the duration over which the conflict resumes. But it clearly would push us more towards an adverse scenario, yes. I think at this stage, what we can say is that we're tending a bit more towards our baseline scenario in which we avoid recessions. There's clearly going to be a soft patch coming for the global economy in the middle part of this year. If the ceasefire unravels, it, as I say, depends upon the circumstances in which it unravels and whether it can be brought back on track relatively soon, in relatively short order. If it can't, and the conflict is dragging on into May and then beyond, then yes, we're then in an adverse scenario. We start to see bigger increases in energy prices in wholesale markets, and then feeding through into consumer prices, and particularly in Europe and parts of Asia, that becomes a major economic headwind.
Let's focus on the more benign scenario. You describe this as a soft patch, almost like a blip. I mean, obviously there's enormous human cost involved. This is a tragedy, but from a global macro perspective, it's an episode. It begins, it ends. The global economy more or less shrugs off the effects of all of this. On that basis, so the inflation numbers that we've had in recent days, I mean, inflation's pretty much spiked across the board, hasn't it? But this morning we had this Chinese PPI inflation that went positive for the first time in 4 years by our team's count. So these inflation spikes that we've seen, are these just basically time capsules, in as much as they reflect what prices were doing while fighting was ongoing, but now we can expect them to fall back?
Yes, up to a point. I think certainly insofar as it relates to China and that March inflation data that we had this week, that can almost all be attributed to the impact of the conflict. So if we look at the PPI numbers, PPI increased 1% month on month, all driven by fuel, by chemicals, by aluminium, and goods that are affected, the price of which have been affected by the conflict, driven up by the conflict. On the consumer price front, we saw a pickup in CPI inflation too. But if you look at core CPI, actually that edged down. So the rise in CPI inflation in China in March was again all energy and the effect of the conflict. So insofar as it relates to China, I suspect that this inflation spike that we've seen in March, if the conflict subsides, if energy markets start to stabilize and prices come down, then we'll see inflation come down. The US, I think, is in a slightly different position. Now, we're talking ahead of the CPI release for March this Friday, but we had earlier this week the PCE numbers for the US for February, and they were really interesting. So what that showed was that inflation pressures were building in the US ahead of the full impact of this conflict being seen. So core PCE, which is the Fed's preferred measure of inflation, that increased by 0.4% month on month. It times that by 12. That's clearly inconsistent with the 2% inflation target. And if you look at the components there, goods inflation going up, potentially the effect of tariffs, services inflation coming down. So yes, again, we'll see what the first effects of the war on US inflation in the March CPI numbers. But there's evidence that inflation pressures were building even ahead of the war and were uncomfortably high. So if it follows that the ceasefire holds, energy markets start to normalize, prices come down, then the energy component part of an inflation spike in the US should start to unwind. But the underlying price pressures, I think, in the US is still uncomfortably strong for the Fed's liking.
So even if the war hadn't happened, we before the war, we had this expectation the Fed would cut once this year. Even if the war hadn't happened, that forecast would have been looking a bit questionable in light of the inflation numbers that were seen in February.
I think so, yes. I mean, we've for a long time argued that ahead of the war, the market had got carried away with expectations of rate cuts by the Fed this year. It kind of bought the line from the White House that rates were too high, that there was going to be a change in Fed chair, and that this would usher in a period of substantially lower interest rates. To our mind, the US economy looked relatively resilient, but also underlying inflation pressures were still uncomfortably strong for the Fed's liking, and that would diminish the scope for rate cuts. And I think that's essentially what we've seen play out in this February data.
What about other central banks? Because a key point here is we're not going back to pre-war conditions, are we? Before the war, we had this expectation that there was a supply glut in the oil market, that Brent would fall to $50 a barrel by the end of this year. Now we're looking more around falling back to $80 if indeed this baseline scenario holds, if the ceasefire remains in place. This idea that we're looking at substantially higher energy prices than had been expected prior to the war, how does that play into other central bank calculations?
Well, the key issue, of course, is what happens to inflation. Now, if we look at Europe, for example, yes, moves in oil prices matter insofar as they then feed into refined products, petrol, diesel, and so on and so forth, of the price of those. But also we need to look at natural gas prices, because that determines to a large extent what happens to utility bills and household electricity tariffs. And one of the things that we have seen over the past few weeks is that natural gas prices have not risen by as much as we may have thought, given the extent of the damage to production facilities in Qatar. So we know, we spoke a few weeks ago, didn't we, that strike on the Qatari facilities knocked out about 20%, just under 20% of Qatari production. The Qatari authorities suggested it would take between 3 and 5 years to make repairs and to get that production restored. We've not seen much of a response in prices to that reduction in supply, to that damage in supply. So that's been a positive for Europe. So when we start to look at what that means for inflation, it might mean that inflation in the UK peaks at around 4%. In the Eurozone, it might peak at just over 3%. So clearly uncomfortable for central banks, clearly higher than the Bank of England and the ECB would like, but it doesn't get you back into 2022 rates of inflation, particularly against the backdrop of ultra-loose monetary policy back then, and they're scrambling suddenly to tighten monetary policy, trying to anchor inflation expectations against the backdrop of tight labour markets. There's a much more modest increase in inflation that I think is coming down the pipe. Now, that will squeeze household spending, squeeze real incomes and spending power, but I don't think it's going to get the Bank of England, the ECB, other central banks in Europe scrambling to tighten policy in the face of higher inflation. I think at these rates, they'll just be able to look through it.
We've spent a long time talking about inflation risk. What about growth risks? I mentioned the Fed there, our earlier expectation for a rate cut. Would also come into this year expecting the Bank of England, the ECB, indeed, to be cutting rates. Are there any scenarios in which those cuts come back onto the table?
Possibly, if we end up with a swift resolution to the conflict, energy prices start to come down quite quickly. Maybe we even see production through the Strait of Hormuz is restored rapidly, and Saudi continues to use the East-West pipeline to pump more production out, and OPEC Plus increases output. Then that could bring down energy prices even more. There are scenarios where you could imagine quite a big fall in energy prices that would dampen or blunt the increase in inflation, and then central banks could start to focus on the kind of underlying growth dynamics, which are weakening. It's not just in Europe, but if you look at the US numbers, we've just had, as I say, the personal consumption data for Q1. It's not looking particularly good. So there are scenarios where you could get some rate cuts. I just don't think at this stage they're the most likely outcome, frankly. And it would take a period of more substantial economic weakness for those to materialise.
So inflation is the bigger risk at the moment than growth.
I think on balance, policymakers focused a bit more on inflation because growth is just about holding up. It's a pretty delicate balance, though, at this stage.
I know that you and the team have been fielding questions all week about exactly what's happening in the Middle East in terms of the ceasefire, in terms of macro implications. One frequently asked question I know is about the Strait of Hormuz. The Iranians have weaponized the strait. Now they're trying to monetize it. There's talk about imposing levies on shipments going through the strait. We're not military strategists, we're not geopolitical strategists, but we do global macroeconomics. So on that basis, let me ask you, what would imposing levies on shipments through the strait mean from a global economic perspective? Is this just more friction for the global economy?
Well, I think the first thing to say is that the US has said they're opposed to this, at least insofar as the tax would be paid directly to Iran. I think this is going to be another sticking point in negotiations. But let's just assume that the situation does emerge in which taxes are paid in one form or another to allow shipments through the Strait of Hormuz. If that were to emerge, then I think it clearly would depend upon the level at which taxes are set. But at the levels that have been suggested in media reports, about $1 a barrel, that is not going to be large enough to have a major bearing on global energy markets and decisions over output by Gulf producers, particularly when the marginal cost of production in these countries is so low. So the cost of the tax, in a sense, will be far outweighed by the benefits to the global economy of just getting shipments resumed through the strait. Of course, this carries a fifth of global seaborne natural gas, a quarter of global seaborne oil. So in that sense, the kind of benefits outweigh the cost of the tax. If a structure like this does start to emerge, where tolls are paid for transit through the strait, then I think that, again, assuming they're not set at prohibitive rates, then the questions are more political than they are, and geopolitical than they are economic. Who sets the tax? To whom is it paid? Is it paid directly to Iran, or is it paid to a body of powers, of nations that guarantee and provide security through of transit through the strait? What role does the US have in this? How are the tolls set in future? What are the mechanisms by which they might be increased? What are the mechanisms by which Iran might actually say, we don't want it to be set at $1 a barrel. It's going to be now $10 a barrel in order to pay for reparations, for example. What's to stop that? These are the kind of thorny questions. And unless they're fully hashed out and agreed, then I think potentially all this does is, yes, it gets traffic flowing through the strait in the short term. But unless these points are fully fleshed out and agreed, then what it does is potentially in the long run create another potential vulnerability within the global trading system, another weak spot that could be exploited, and again lead to another shock in future.
As you suggest, though, much uncertainty about the status of the strait, and presumably something will come out of these talks due to be held starting this weekend. Lots of uncertainty around in the near term, also in the long term. And there's a tendency at times like this, isn't there, to rush to judgment about what this all means for the future of the global economy. Sure enough, a cottage industry of writers churning out reports about how China is the clear winner of the Iran war. Give us your 2 cents.
I'm going to push back a bit against this hot take. Just in a narrow economic sense, the winners, quote unquote, from this war, I think it's slightly crass in terms of think about winners and losers when millions of people are affected and displaced. But the winners, quote unquote, in a narrow economic sense, are large net energy exporters that are able to ship their products. So we're thinking about here Norway, Russia, Canada. They're the countries that are, in an economic sense, the winners. Where I think China potentially stands to benefit from this war, it's a large net energy importer, but it has demonstrated its energy resilience. So it has diversified its supplies of energy, it has a lot of coal, it has renewables, it's got not just relying on LNG shipments, but also a large and diversified supply of gas through pipelines. And it's amassed enormous strategic stockpiles of fossil fuels as well that it's been able to deploy, and in conjunction with price caps and price controls, been able to ensure that both domestic supplies of fuels have continued and that we've not seen a huge pass through to domestic prices. So in that sense, it's been a kind of relative winner. I think there's also a sense in which clearly China dominates green technologies and renewable technologies. This could spur push towards renewables amongst advanced economies in the future. America has depleted stockpiles of its military stockpiles, and Gulf has depleted military stockpiles too. We know from the trade war last year that critical inputs to that are the rare earths that China has a stranglehold over. As they start to rebuild stockpiles, that will suck in demand for Chinese products there too. And I guess in a geopolitical, geostrategic sense, China has benefited in some sense because it's been able to see the true extent of America's military strength, but also its weaknesses. Military planners in China have been able to observe this in real time. So some sense is there in which China has benefited, if you like, from the war. Whether or not it's a winner, though, in all of this, I'm not so sure. As I said at the start, it's a large net energy importer. It's also, by some distance, the world's largest exporter as well. So its interest here lie in the war being brought to a swift conclusion because, yes, it's been able to demonstrate some energy resilience, but the longer this war continues, the greater that resilience will be called into question. It does import vast amounts of oil still and gas. And to the extent that a protracted conflict starts to weigh on growth elsewhere in the world and threaten recessions in Europe and so on and so forth and other parts of Asia, that will weaken demand in key export markets for China. I think there's also in a geopolitical, geostrategic sense too. If you're President Xi, you're sitting in Beijing, you've seen Russia's military now struggle to overcome a much smaller adversary in Ukraine. You've seen America's military struggle to overcome a much smaller adversary in Iran. And clearly that has uncomfortable parallels for China and Taiwan. So I wouldn't go as far as to say that China's been a clear winner from this war. And it certainly is in China's interest to see the war brought to a relatively swift conclusion.
That was Neil Shearing on a ceasefire in the Middle East and its economic implications, as well as some of the potential longer-term consequences of this war. I should say we were recording just after 9 o'clock London time on Friday, so 4 a.m. in DC, around 12:30 in Tehran. Our dedicated Iran page remains the go-to for key analysis on the macro and market consequences of the conflict, including our latest forecasts, on which more later. Our climate and commodities team were answering client questions online Thursday in one of our drop-ins. These are our short-form online briefings. The session was all about what's happening in commodity markets. Obviously, the status of energy supply dominated discussion, and here is a clip from that briefing. You will hear climate and commodities economists David Oxley, Hamad Hussein, and Kieran Tompkins. And it starts with Kieran talking about where we are with oil supply in light of the ceasefire news.
I think the first thing to stress is that There's some very long lags involved with shipping this oil from the producers to the consumers. And I think that's evidence in just how physical shortages haven't really manifested yet. So, for example, it was just last week that the UK received its last cargo of jet fuel from the Middle East. And so on the flip side, where exports resume, the situation is just mirrored. You can kind of apply the same amount of time with some, sizable lags before any shortages that appear in the meantime will be resolved. But there's also, some additional complications around all of this as well. Some of these around just the situation as the ceasefire and whether it holds. But also it's around the details with there only being a 2-week deadline announced so far, which, it may only allow for tankers that are already in and around the strait to potentially export oil. And it would be a pretty huge gamble for any tankers further afield to try and sneak into the strait, load up and exit the Strait of Hormuz in that time frame. But even in a, optimistic scenario where a resolution is reached and tanker operators do have the confidence to navigate the strait, it's probably most likely to be a stuttering resumption of flows. Oil producers in the Middle East have been proactively winding down oil output. So in order for them to export at their pre-war rate, once, the strait is open for business, Gulf countries would probably have to tap storage tanks. And just whether that could bridge the gap would depend on just how quickly production could be brought back online. And for a little bit of context on that, the EIA estimated that in March, about 7.5 million barrels per day of oil production had been shut in the region. And we probably suspect that, it varies from oil field to oil field, just how quickly things could be brought back by. But by all accounts, it's something that will take some time. It's not something you can just flip a switch on. And then in any case, after all of that, we're back to these long lags where it takes weeks for tankers to reach refiners and then be sent from refiners to end consumers. So expect a stuttering return of oil supplies.
So things are not going back to normal anytime soon again. And then can you just give us a bit of backdrop and context as to how the current situation fits in with our baseline scenario for crude exports, but more importantly, I suppose, crude prices and what we're expecting?
Yeah, of course. So just to outline the baseline scenario, which we've held for some time now, it's one which assumes that the conflict eventually de-escalates by the end of this month, and then energy flows through the Strait of Hormuz resume along kind of like a similar time frame. And our oil price forecasts are reflective of what I've kind of described before, of this stuttering resumption of flows where we won't get back to something reflecting normalcy straight away. So in the oil price forecast, it's a profile of where we forecast Brent prices to end Q2 at $95 per barrel. So not that far off where they are now, before then easing lower to 85 and 80 by the end of Q3 and Q4 respectively. And I think an important thing to highlight there is that end 2026 forecast is higher than what we were forecasting before the war.
Bringing you in, Hamad, obviously we were discussing crude oil flows, which is clearly important. But one thing we've been highlighting that's really important for the knock-on transmission of this energy crisis into the real economies is the impact on oil products, both those normally refined in the Middle East, but also as a knock-on impact of the sort of dislocation we've seen in crude flows. Can you just talk us through how we think that's going to play out in this scenario, a scenario in which traffic does eventually resume over next 4 to 6 weeks through the strait? How that sort of impact plays out at a product level in terms of margins as well.
Yeah, so as you alluded to, David, you've got this sort of almost double shock happening in products markets. Like crude, there's a lot of refined products that go through the Strait of Hormuz. About 30% of all oil flows through the strait is made up of products. But also what's happened is because refiners, particularly in Asia, haven't been able to get their hands on enough crude from the Middle East, they've been cutting refinery runs and producing less output. So that's reducing the overall supply of refined products globally. And that's been a key reason for why there's been a large blowout in product prices and much larger increases than what we've seen in crude benchmarks. I think in terms of how this plays out, I think it will take a bit longer to iron out some of the kinks in product markets and supply more generally. There's a similar case where, like crude from the Arabian Gulf, it will take time for that to be shipped and reach customers. Products from the Gulf will also take time to be shipped. But there's also a lag involved from when the crude is shipped to refiners and then through from refiners sort of ramping up output. That takes time. It's similar cases with crude output. It's not like turning on a switch. That's a whole process that's quite gradual. And then it takes some time for the product to then be shipped from the refinery to the end user. I think another thing to note is that what we've seen over the past month is that it seems as though refinery infrastructure has been more impacted by strikes in the Middle East. I believe around 1/3 of Middle Eastern refinery capacity has been impacted by strikes in one way or another. It's pretty unknown in terms of the extent of damage to refineries in the region. But again, I think where there is damage, that will complicate things and mean that it takes a bit more time for product supply to normalize over the coming months. So overall, it's a similar case as Kieran was describing, where even if the conflict were to come to a complete end tomorrow and the Strait of Hormuz was to flow freely, then in products markets, it will take time for those dislocations to sort themselves out.
That was Hamad Hussein along with Kieran Tompkins and David Oxley talking about the state of global energy supply. I will link to the full recording in the podcast notes because they covered off a lot more, including what's happening with LNG, what we know about energy demand destruction, and the outlook for gold and for industrial metals if the ceasefire holds. We run several drop-ins each week covering the full spectrum of macro and market interests. We've got 4 alone in the coming week, starting Monday with a day after briefing about Hungary's pivotal election this weekend. There's dedicated Asia, EM and commercial real estate sessions too. Details of all of these are available on our events page, capitaleconomics.com/events. And if you want invites to all our drop-in sessions to get answers directly from our economist team, along with our written analysis, our data tools, and much more besides, send us an email at podcast@capitaleconomics.com and we can set you up with immediate trial access. Finally this week, to financial markets. There's a perception that they've held up fairly well in this conflict, but how much more can they recover if the ceasefire holds? To find out, I spoke to senior markets economist James Reilly ahead of the US market open on Friday. His team's just published a new set of forecasts based on our baseline and adverse conflict scenarios, and I asked him about them. Here's that conversation now. It starts with James talking about how markets have been responding to the ceasefire news.
So markets have responded predictably enthusiastically. So the S&P 500 is now back to just 1% off its all-time high. Interest rates expectations have kind of fallen back. So expectations for hikes in the US are now off the table. And in fact, this morning, there's a growing sense that rate cuts might be back on the agenda for this year, even though that's not our view yet. Cyclicals have outperformed defensive sectors within the US stock market. High yield credit spreads in the US have actually narrowed since the outbreak of war. Earnings expectations in every sector of the S&P 500 have risen throughout the war, and valuations have now started to return to their pre-war levels too.
You're talking about credit spreads narrowing. You're talking about the S&P now just 1% off its all-time. I mean, financial markets have been pretty resilient through this war, haven't they? What do you think explains that?
Yeah, we think there's 2 parts of it. The first is the US economic data has generally held up throughout this period. So commonly watched economic surprise indices are still in positive territory. The other element is that if you step back from the cyclical concerns around the Middle East and higher energy prices, there's also this secular theme of US-centric AI boom in the stock market. So apart from the energy sector in the S&P 500, which has obviously risen throughout this war period, the IT sector is also the other sector that is on net risen since the war began. That partly reflects that it came into the war on soft footing after concerns around the software industry and the headwinds from AI. So there's a bit of recovery from that. But still, it's clear that enthusiasm for AI is one reason that the US stock market has outperformed over the past 6 weeks or so during this conflict. and has very quickly returned back towards its all-time high.
Nonetheless, some things did get broken here, didn't they? I mean, you've just published a new set of financial market forecasts. Talk about where we're seeing sort of major indices by the end of this year for equities versus where our forecasts were pre-war.
So as you say, there is going to be some residual lasting impact from the last few weeks. We've slightly pared back our expectations for global economic growth and in turn slightly pared back some of our enthusiasm around risky assets. So for a long time now, since around mid-2023, we've been amongst the most bullish forecasters on global equities and US equities in particular. We've been around the top of every consensus form since that period or over that period. We have slightly pared back our forecast for the S&P 500 since the war began. So as we entered the conflict, we had forecast the S&P 500 to rise to 8,000 this year. We've pared that back slightly to 7,500, although that's still a rise of around 12% from its current level. So still pretty bullish and still around the top of most consensus surveys. Elsewhere, we remain pretty bullish on global equities outside the US too, although that's particularly true of tech-heavy indices in Asia, such as Taiwan, Korea, Japan, and China. In the likes of Latin America and much of emerging Europe, we're a bit more downbeat. That's largely influenced by our view that commodity prices, in particular energy prices, will fall back and weigh on commodity-heavy indices. And we're also quite downbeat on the outlook for Canada's stock market, where there's a heavy dependency or heavy correlation with gold prices, where we have a pretty downbeat view.
And talk a bit about, you mentioned yields, we'll talk a bit about what's been happening in bonds. When near the start of the war, the markets team, you guys were arguing that the move in bond yields and government bond yields was overdone, that there was some scope for recovery. Now we've had this news of ceasefire. Yields have come off. They've fallen a bit. Is that trade still in motion or has it run its course?
Yeah, so in the US, the 10-year Treasury yield is still around 30 basis points higher than when it entered the conflict. The 10-year TIPS yield is around 20 basis points higher. But at the same time, as you say, it's come a long way from its recent peak. We think that move has a little bit further to run, so we expect the 10-year Treasury yield to fall back from 4.3 now to 4.25% over the coming months. So a pretty small move. But the story in other government bond markets is perhaps more interesting. So we continue to think that gilt yields are too high across the curve, so we're particularly bullish on the outlook for gilts. And likewise, we think German bond yields have plenty of scope to narrow. Our Europe Economics team has today taken out any expectations of rate hikes this year, whereas the market still prices in around 50 basis points worth of hikes this year, and interest rates remaining at that level next year. So we now think plenty of scope for German bond yields to rally, and indeed periphery spreads to narrow too as fiscal concerns fall back and risk appetite recovers.
I wanted to ask about risks. I guess the key risk is that this ceasefire doesn't hold and that markets quickly have to reprice their expectations. What happens in that event?
Yeah, so I think quite predictably in that event, we just see a repeat of what we saw over the last 6 weeks. So government bond yields rising as interest rate hikes come back onto the table, the US dollar probably strengthening on the back of safe haven demand and the terms of trade shifting in its favor, and equities generally coming off the boil. Now, for the last few weeks, we've been using a framework where we've had a baseline scenario where things proceed broadly as they have in recent days, with tensions easing by the end of April and things starting to get back to a more normal footing. But we've also been discussing and talking to clients about an adverse scenario where the conflict rumbles on for a few months longer than that and has a more sustained impact on financial markets. Now, in that view of the world, which we outlined in our recent global outlook, we actually forecast the S&P 500 to fall back to 6,500 this year and actually remain there next year. So that's a pretty negative view of the world. Outright falls in equities, which would be far below the consensus expectations. We'd also think in that view of the world that Fed rate hikes would probably be back on the table, and certainly rate hikes in much of Europe, including the Bank of England and the ECB. So in a more adverse scenario such as that, we do think bond yields would certainly not fall back and perhaps would have scope to rise. So I mentioned we have about 50 basis points worth of hikes priced in for the ECB. In a more adverse scenario where the conflict rumbles on for 3-4 more months and has sustained damage to energy infrastructure, we think 50 basis points probably looks about fair. You might even get 75 basis point worth of hikes this year from the ECB. Although we do think for structural reasons that those that interest rates would not remain at those levels for particularly long, and you might once again see rate cuts coming onto the cards next year. In the Bank of England, we had about 4 hikes priced into the market a few weeks ago. We think that was overblown at the time. We think you'd only get that in a particularly adverse scenario. So we don't think scope for gilt yields to rise beyond the levels they reached a few weeks ago. We think as of mid-March or late March, gilt yields were preparing for a worst case outcome. So even if things did deteriorate from here, we don't think gilt yields would rise past their recent highs.
James Reilly there on the market's outlook. Alongside our new forecasts, he's just published a new report called Mapping the Next Stage of the AI Rally. It's analysis which kicks the tires on the narrative that this technology can continue to drive equities, not just in the US, but in markets like Japan, China, and Taiwan too, as well as the impact of AI on market sectors like software, which have been hammered in recent weeks. I'll add a link to that analysis in the podcast notes. Again, if you're not a capital economics client, but you want to speak to James or any member of the Economist team about what lies ahead for macro and markets, get in touch at podcast@capitaleconomics.com and we'll get you on a trial. But that's it for this week. We will be back next week with much more on the state of the global economy and markets. Until then, goodbye.